Welcome to The Deep Dive. We're the show that unpacks earnings calls for experienced investors, finding the signals in the noise.
And today, we're jumping into USA Compression Partners. They just reported their Q2 2025 results.
That's right. USAC, a key player in natural gas compression, basically making sure gas gets where it needs to go. They're critical midstream infrastructure.
Absolutely. And our goal here is to really break down what their latest numbers and comments mean, looking beyond just the headlines.
So let's get right into those results. Overall, a pretty strong showing for Q2, and you say they beat expectations.
Definitely. GAAP EPS came in at 22 cents. Consensus was looking for $0.21, so a nice beat there.
And revenue looks solid, too, $250.1 million.
Yeah, beating the $247 million consensus and up was at 6.3% year over year, so good growth.
Pretty healthy growth. What else stood out from the financials?
Well, Adjusted EBITDA was up 4.0% year over year to $149.5 million.
Yeah.
And importantly for an MLP like this, distributable cash flow, DCF, also saw a nice bump. It's $89.9 million. That's up 4.7% compared to last year.
Okay, so cash flow looks good. And I noticed their pricing metric, the average revenue per horsepower per month, also ticked up.
It did, up 5% year over year to $21.31. That suggests they've got some real pricing power in this market.
And maybe the most telling number, for me at least, was utilization.
Holding firm at 94.4%. That's pretty remarkable, right?
Yeah.
Especially given some softness in parts of the energy space maybe earlier in the quarter.
It really is. It says a lot about the demand for their specific services, especially the large horsepower units. So the market reaction was just sort of modestly positive, maybe a bit muted given the strength.
You could argue that. It seemed constructive, but maybe not fully reflecting the commentary.
So speaking of commentary, how did management actually frame the quarter? What was their perspective?
They were very positive. The CEO called it a record-setting quarter for revenues and revenue per HP, really emphasized the strong demand across oil and gas basins.
Okay, so not mincing words there, record-setting.
Not at all. And remember, there was some slightly bearish chatter out there earlier in the quarter, worries about the economy, commodity prices dipping a bit.
Right, WTI and Henry Hub weren't exactly soaring.
Exactly. But management said they saw resolve among their E&P customers, their producer clients, looking out to the second half of 25 and into 2026.
Resolve. That's interesting. It implies customers are looking past any short-term wobbles.
That's the implication. Like maybe a brief pause for some, but the long-term plans are still moving forward. They even specifically mentioned expecting contracted horsepower in the Northeast to climb 5% by Q4.
And what about their biggest customers? Any signals there?
Yeah, this was pretty striking. Their top 10 customers, making up over 45% of revenue, by the way, are apparently expected to grow production next year, not just maintain it.
Grow production. Okay, so that really begs the question. What is underpinning all this demand? It sounds like more than just typical drilling cycles.
And that's where management spent a lot of time on the call. They pointed squarely at massive secular demand drivers for natural gas.
Not just oil and gas activity, but something bigger.
Much bigger, potentially. We're talking AI, cloud computing, data centers. The sheer power required for all this stuff is astronomical.
Right. I saw the numbers they mentioned. 3 of the biggest U.S. tech firms spending over $265 billion combined this year alone on AI and cloud infrastructure.
It's staggering. And that spending translates directly into power demand, which means natural gas demand. They kept highlighting new data center announcements popping up constantly.
Like those recent ones, a 4.4 gigawatt complex, another under 90 megawatt one. Yeah. These things need reliable power.
And utilities are scrambling to keep up too, investing over $200 billion this year to meet power demand, way more than any year since 2000.
And management's argument is that natural gas is really the only fuel source that can provide that kind of consistent, reliable, and relatively clean power at scale right now.
That was their core message. They even brought up this idea that the gas market has flipped, from being supply-driven to demand-driven because of forces like AI.
It's a compelling narrative. And it wasn't just the AI story, right? The EIA's outlook also pointed to growth.
Yeah, the July short-term energy outlook, it showed pretty considerable growth projections, like 6% annualized growth in the Permian, plus expected growth from the Northeast and the Haynesville, too. So it's broad-based demand.
Okay, so it sounds like a pretty powerful long-term tailwind for their business. Let's switch gears a bit to the financials guidance and the capital structure. Any big changes there?
They actually reaffirmed their full year 2025 guidance. So Adjusted EBITDA still expected between $590 and $610 million, and DCF between $350 and $370 million.
Holding steady on the outlook. And CapEx plans.
Also reaffirmed. $120 to $140 million for expansion, $38 to $42 million for maintenance this year. They spent about $18 million on expansion in Q2.
Seems pretty straightforward. Was there anything else on the financial side that caught your eye?
Oh, absolutely. A really significant update on the equity structure, the Series A preferred units.
Ah, right, the conversions. What's the latest?
As of early August, 420,000 out of the original 500,000 had already converted to common stock.
Wow, so only 80,000 left.
Exactly. That cleans up the capital structure quite a bit. It should reduce their future cash obligations for preferred payments, which helps distribution coverage down the line. It's a big de-risking move.
Definitely simplifies things. And where does that leave their leverage?
Currently sitting at 4.08 times debt to EBITDA. They stated their target is to get that down towards or even below 4.0 times.
Makes sense. Any plans on the debt side? Refinancing?
Yeah, they mentioned looking at refinancing their 2027 notes, probably starting in Q4, and also extending their ABL facility. They seem to think they can get better borrowing costs.
Optimizing the balance sheet. And they made a point about the distribution, didn't they?
They did. Still a top priority. And they highlighted hitting 50 straight quarters of consistent distributions.
50 quarters. That's quite a streak in this industry. It speaks to operational consistency.
It really does. Which is a good segue into operations and costs. They talked about managing their big three costs.
Wrong.
Parts, labor, and lube oil.
What's the plan there? Labor costs ticked up in Q2, right?
They did, yeah. Mostly due to overtime and using contract labor. But they expect that to ease as they bring on more internal hires. They're pushing hard on recruiting, aiming for 100% staffing internally.
Trying to bring those costs down. What about the others?
They expect significant savings on lube oil thanks to a new deal with a major vendor. And they're starting to see benefits from the shared services model with Energy Transfer.
Ah, the integration benefits. How much are we talking?
Things like licensing savings, better IT. They're projecting about $5 million in annualized G&A savings starting in 2026 from that.
Okay, $5 million. Every bit helps. Any impact from tariffs? Always a concern.
Apparently minimal. They stress that most of their key components are made in the U.S., which shields them quite a bit.
That's a good position to be in. And equipment lead times. Still manageable.
Seems so. Engines are running 34 or 45 weeks. Compressors 24, 28 weeks. No major changes reported there.
Right, so operationally, they seem focused on efficiency and supply chain is stable. What about growth, the actual horsepower outlook?
This is where it gets interesting for future revenue. They have about 39,800 large horsepower units currently on order.
Nearly 40,000 HP on order. When does that start coming online?
Deliveries expected within the next 12 months. And crucially, they expect 10,000 of that to be up and running by January 2026.
Okay, so a clear line of sight to near-term growth. What does that mean for their active fleet?
They're projecting their active horsepower will top 3.6 million in Q4 of this year. That would be a new company
With
record.
new record, even though total active horsepower dipped slightly quarter over quarter?
Right. But the key is that large horsepower, the stuff driving the new demand, remains almost fully utilized. And their recontracting rates are up too.
So existing assets are in demand, new assets are coming. Can they still get good returns on the new, more expensive horsepower?
They said yes. Even with higher acquisition costs over the last couple of years, they can still hit the margins they need on new equipment deployments.
And they mentioned another growth avenue, buying contract back.
Yeah, basically buying compression assets from producers who want to free up capital and then leasing those assets back to them under contract. It's another way to add horsepower without purely relying on new builds.
Makes sense. A flexible approach. So let's try and tie this all together for investors listening. What's the big picture takeaway here?
Well, I mean, the performance clearly shows that underlying demand and compression is strong, especially for those big units USAC focuses on. It seems very real.
Yeah, that consistent utilization, the pricing power they showed, even when the macro felt a bit shaky in Q2, it highlights how essential their service is. They're well-positioned in key areas.
Absolutely. And that whole narrative around AI and data centers driving gas demand, that provides a really compelling long-term story. It potentially changes the game beyond just the usual E&P cycles.
It could create a much higher, more stable demand floor for natural gas and, by extension, for their compression services. It feels like a structural shift.
And don't forget the financial de-risking. Those preferred conversions cleaning up the balance sheet are a pretty big deal for improving cash flow available for distribution down the road.
Right, so you have strong operations, a clear secular tailwind, and an improving capital structure. Yet the stock reaction was, as we said, kind of modest.
Which might suggest, a potential opportunity. Maybe the market hasn't fully baked in the impact of these catalysts yet, especially the AI demand angle. There could be room for catch-up relative to the fundamentals.
So what should investors be watching for going forward?
Definitely keep an eye on Q3 updates. How are those horsepower deliveries tracking? What's the pricing mix looking like? Any hints of guidance changes on the November call will be key.
And tracking the pace of those remaining preferred conversions, plus the macro triggers, gas prices, E&P activity, and crucially, more evidence of that AI and data center demand really accelerating.
Exactly. Those are the signals.
Okay, so thinking about all this, robust quarter, strong outlook, that huge AI demand story leads us to our not financial advice segment. Time for a trade idea.
All right, let's hear it. Given management's confidence record setting, aiming for a Q4 record in horsepower, and that maybe underappreciated AI angle.
Yeah, the stock's drift up felt maybe a little too calm. So for the investment committee's consideration, how about looking at long-dated call options?
Ooh, interesting. Go on.
Think like December 2026 or maybe even June 2027 expirations. Give it plenty of time and maybe target something, say, 10-15% out of the money.
Okay, so a leveraged bet on the longer-term story playing out. What's the core rationale?
It's really a bet on two things. One, management executes. They get that nearly 40,000 horsepower online, driving higher revenue in DCF, which could lead to the market valuing the company more richly, multiple expansion.
Makes sense. And the second part?
The second part is the market really catching on to this demand-based market for natural gas driven by tech infrastructure. If that narrative gains broader traction, USAC could see a significant rereading, moving beyond just being seen as a traditional midstream MLP.
So you're giving the thesis time for the new units to come online, for the preferred conversions to fully resolve, and for that whole AI-driven demand story to become mainstream investor consensus.
Exactly. It's a patient way to potentially capitalize on what looks like a pretty fundamental shift in the energy landscape, focusing on a company right at the center of it.
A provocative idea, playing the long game on both execution and a market narrative shift.
So just to recap quickly, USA Compression Partners, strong Q2, record revenues, better pricing, holding guidance steady.
Underpinned by solid demand, especially for large horsepower, and this potentially huge long-term growth driver from data centers and AI.
Plus, the capital structure is simplifying nicely with those preferred conversions, which should bolster the distribution story.
A lot of positive signals converging.
Definitely. Now, as always, please remember everything we've discussed here is purely for informational purposes. It is absolutely not financial advice.
Please do your own research. Consult with a qualified financial professional before making any investment decisions. Seriously.
We'd love to hear what you think about USA Compression's quarter. Find us on social media, join the conversation. Thanks for tuning in to The Deep Dive.
We'll catch you on the next one.